Imagine waking up one morning to headlines screaming that the financial institutions you've trusted for decades are on shaky ground. Legendary investor Stanley Druckenmiller, known for navigating some of the most turbulent markets in history, warns that 2026 could bring unprecedented challenges for banks and depositors alike. As confidence wavers and uncertainty looms, the question isn't just whether banks are dying, it's how you can protect your hard-earned money before it's too late. Understanding the risks and preparing strategically might be the difference between weathering the storm and being swept away. Diversifying your holdings beyond traditional banks is no longer just a smart financial strategy. It's becoming essential for anyone who wants to safeguard their wealth in an unpredictable market. When legendary investors like Stanley Druckenmiller raise alarms about the fragility of banking systems, it's a signal to take a hard look at where your money is stored and how exposed you are to risks that were once considered remote. Most people rely heavily on a single bank or a handful of familiar institutions, assuming that deposits are secure and that the institutions themselves are too big to fail. But history and recent financials tell a different story. Even the most established banks can face sudden liquidity crises, mismanagement issues, or systemic shocks that ripple through the economy faster than most notice. By spreading your assets across multiple avenues, you reduce the danger of being caught off guard and increase your options when uncertainty strikes. Diversification in this context doesn't just mean opening multiple checking or savings accounts at different banks. It involves a strategic allocation of funds across a variety of financial instruments and platforms. For example, a portion of your wealth can remain in traditional insured accounts for day-to-day liquidity and peace of mind. Another portion could move into government-backed securities, which often carry minimal risk while providing steady returns. Some investors also look at bonds, both corporate and municipal, as a middle ground between safety and growth, offering a predictable income stream even in turbulent markets. Real estate, particularly through investment trusts or property funds, can also act as a stabilizing asset because it isn't tied directly to the banking sector's short-term volatility. Even alternative investments, such as commodities or precious metals, can serve as a hedge against financial instability, acting like a safeguard when conventional systems stumble. It's important to approach this process methodically. Randomly scattering money across multiple banks or investments without a plan can lead to confusion, higher fees, and exposure to risks you didn't anticipate. Instead, start by assessing your current portfolio and understanding which institutions or assets dominate your holdings. Identify concentrations of risk. For instance, having the bulk of your savings in a single bank, especially one with a high exposure to volatile markets or speculative lending, creates vulnerability. Then research options for diversification that align with your financial goals, risk tolerance, and liquidity needs. This could mean opening accounts at smaller, regional banks with strong balance sheets, exploring credit unions with robust insurance coverage, or investing in reputable online banks that offer FDI protection along with competitive interest rates. Another crucial aspect is geographic and regulatory diversification. Banks in different regions or countries are subject to varying economic pressures, regulatory oversight, and financial climates. By distributing your holdings across institutions that operate under different regulatory frameworks, you reduce the risk of being affected by localized banking crises. For example, while one country may face rising default rates and tightening monetary policy, another may offer more stable economic conditions, providing a counterbalance to your portfolio. Of course, international diversification introduces its own complexities, such as currency risk, tax implications, and varying deposit protections. But with careful planning, it can serve as a powerful shield against systemic banking threats. Technology also plays a role in modern diversification strategies. Fintech platforms, digital wallets, and online banks provide opportunities to manage funds efficiently while spreading exposure. These platforms often allow for easier monitoring of balances, transfers between accounts, and access to diverse investment products that traditional brick and mortar banks may not offer. However, relying solely on technology isn't enough. You must ensure that these platforms are secure, insured, and reputable. In some cases, splitting funds between traditional institutions and vetted digital alternatives can combine the benefits of stability and convenience while minimizing risk. Psychology and discipline are equally critical. When warnings about financial instability emerge, there's a tendency to react impulsively, moving money hastily, chasing higher yields, or trusting untested alternatives. Effective diversification requires calm, rational decision making, guided by research and a clear understanding of your objectives. Creating a structured plan, reviewing it regularly, and adjusting allocations based on evolving market conditions ensures that your portfolio is resilient without being chaotic. Consistency matters more than trying to predict every sudden twist in the market, and strategic diversification allows you to sleep at night knowing that no single failure can wipe out your financial foundation. Diversifying also means thinking beyond your own savings to include retirement accounts, business funds, and other financial obligations. Concentrating risk in one sphere, such as relying solely on a retirement plan tied to a single banking or investment provider, exposes you to potential disruptions that could have long-term consequences. By spreading assets across different account types, institutions, and instruments, you create a network of financial defenses that support both your present needs and future goals. This layered approach, informed by the kind of insights Stanley Druckenmiller emphasizes, transforms diversification from a theoretical principle into a practical strategy capable of weathering crises, protecting wealth, and providing flexibility in uncertain times. Even as market conditions evolve, the core principle remains clear: no single bank, no matter how prestigious or well capitalized, should hold all your financial security. By actively seeking variety in where and how your money is held, you position yourself to respond to crises rather than be victimized by them. This approach not only safeguards your assets but also empowers you to take advantage of opportunities that arise when others are paralyzed by fear. Diversification is more than a hedge, it's a strategic shield, a means to navigate the unpredictable waters of the financial world with confidence, foresight, and control. Keeping cash in insured accounts and safe instruments is one of the most fundamental steps you can take to protect your wealth in a world where banking stability is no longer guaranteed. When markets shift unexpectedly or a banking crisis emerges, liquid funds that are fully protected by federal or government insurance can serve as your lifeline, giving you immediate access to resources without the fear of sudden losses. Many people underestimate the importance of liquidity and security, focusing instead on chasing higher yields or speculative returns. While growth-oriented investments have their place, there is an unparalleled peace of mind that comes from knowing a portion of your wealth is completely safeguarded, impervious to the whims of a collapsing financial institution or sudden market panic. Insured accounts are not just about safety, they are about control, about being able to act decisively when circumstances demand it. Understanding the different types of insured accounts is critical. In the United States, the Federal Deposit Insurance Corporation, or FDIC, guarantees deposits up to a specific limit per depositor per insured bank. This means that even if a bank faces insolvency or bankruptcy, the insured portion of your deposits is protected. Similarly, credit unions offer comparable protection through the National Credit Union Administration, or NCUA, insuring members' funds up to the designated limits. Globally, many countries have their own deposit insurance schemes, each with distinct coverage limits, eligibility criteria, and institutional safeguards. Familiarizing yourself with protections is not optional, it is essential. Knowing exactly how much of your money is covered, under what circumstances, and through which channels allows you to plan effectively. Ensuring that your most critical funds remain secure even in extreme scenarios. Safe instruments extend beyond simple savings accounts. Treasury bills, government-backed bonds, and other sovereign debt instruments offer another layer of security, while often providing predictable returns. Unlike commercial bank deposits, these instruments carry minimal risk of default, because they are backed by the full faith and credit of a government. They can serve as a reliable vehicle for parking cash that you may need in the short or medium term, providing both safety and modest growth. Even in times of economic turbulence, these instruments are usually among the first assets to maintain value and liquidity, making them essential tools for anyone seeking stability in an increasingly unpredictable financial landscape. The strategic placement of assured funds also plays a pivotal role, spreading deposits across multiple institutions, each within the limits of government insurance, not only maximizes protection but also reduces the likelihood that a single bank's failure will disrupt your financial life. For instance, instead of keeping all savings in one large, nationally recognized bank, consider distributing funds across smaller regional banks or credit unions that are FDIC or NCUA insured. The result is a network of protected deposits that remains accessible, flexible, and resilient, even if one institution encounters difficulties. This layered approach requires careful planning and record keeping, but the payoff is a fortified financial position that allows you to weather shocks without panic or urgency. Attention to account types and structures is equally important. Individual accounts, joint accounts, retirement accounts, and trust accounts often have different insurance limits and rules. By understanding these distinctions, you can strategically allocate funds to maximize coverage, ensuring that every dollar at risk is shielded by insurance wherever possible. For example, splitting assets between individual and joint accounts may double the insured limits, while certain trust arrangements can provide additional layers of protection. This level of planning might seem meticulous, even tedious, but in a crisis, it can mean the difference between losing access to essential funds and maintaining full financial control. Liquidity planning goes hand in hand with insured accounts. Access to cash when markets are under stress is invaluable. Some assets, though safe, can be difficult to convert quickly without incurring losses or penalties. Insured deposits and short-term government instruments offer immediate liquidity, allowing you to cover living expenses, seize opportunities, or move funds to more favorable positions during market turbulence. This combination of safety and accessibility is what separates effective financial protection from theoretical security. You need funds that are both secure and actionable, ready to be mobilized exactly when you need them most. Psychology and discipline again play a critical role. Many people assume that keeping money in a bank automatically guarantees safety, but history shows that perception and reality often diverge dramatically. Bank failures, cyber breaches, and systemic shocks can erode confidence quickly, leaving unprepared depositors scrambling. By proactively placing funds in insured accounts and safe instruments, you not only protect assets but also reduce stress and enhance decision-making under pressure. This psychological security is invaluable, allowing you to act strategically rather than react impulsively, even when the financial environment becomes chaotic. The rise of digital banking adds both opportunities and considerations. Online banks often offer higher interest rates on insured accounts, but it is crucial to verify FD or equivalent coverage and understand withdrawal mechanisms. Some accounts may be insured, yet complex terms or limited access could hinder rapid liquidity when it is needed most. Balancing convenience, returns, and security requires attention to detail and careful monitoring. Leveraging modern banking technology alongside traditional protections allows you to optimize both safety and accessibility, ensuring that insured funds are not just theoretical safeguards but practical tools in managing risk. Strategically keeping cash in insured accounts and safe instruments transforms your financial position from one of vulnerability to one of resilience. It provides a foundation that is impervious to sudden institutional failures, market shocks, or systemic disruptions. This approach requires planning, knowledge, and discipline, but it is one of the most powerful moves you can make to protect your wealth and maintain confidence in uncertain times. Considering government-backed securities and bonds as part of your financial strategy is an essential step when the banking sector feels uncertain and market volatility is rising. While insured accounts provide safety and liquidity, they often offer minimal returns, especially in low interest environments. To balance protection with allocating funds to government-backed instruments introduces a layer of security with predictable yields, allowing your wealth to not only survive turbulent times but also maintain its value against inflation and market swings. Investors like Stanley Druckenmiller have repeatedly emphasized the importance of recognizing where systemic risks lie and positioning assets in instruments that minimize exposure while offering stability. Government securities, from treasury bills till term bonds, provide precisely that combination of predictability and protection. Treasury bills, often referred to as T-bills, are short-term government securities that mature in a year or less. They are considered among the safest investments in the financial world because they are backed by the full faith and credit of the government. Unlike corporate bonds or stocks, their value is not subject to market speculation or the financial health of private institutions. Investors purchase T-bills at their face value, and upon maturity, the government pays the full amount, effectively providing a guaranteed return. During periods of banking instability, T-bills act as a haven, offering both security and liquidity. Unlike savings accounts, which may be limited by interest rates and institutional policies, T-bills give you a clear, fixed return while keeping capital relatively liquid. Government bonds expand this concept to medium and long-term horizons. Bonds issued by stable governments carry low default risk, and interest payments are often fixed, providing a reliable income stream. This predictability is invaluable when other parts of your portfolio face volatility, as it allows you to forecast cash flows and plan expenditures with confidence. Bonds can also be diversified by duration, issuer, and type, allowing you to create a laddered portfolio that smooths returns and reduces reinvestment risk. A laddered strategy involves purchasing bonds with varying maturities so that some assets mature regularly, providing ongoing liquidity while others continue to accrue interest over time. This approach balances access to funds with income generation, ensuring that you are not forced to sell assets at unfavorable times. Inflation-protected securities, such as Treasury inflation-protected securities or TICE in the United States, add another layer of sophistication to your strategy. These instruments adjust the principal value based on inflation metrics, meaning your investment retains purchasing power even as prices rise. In a year when banking crises coincide with inflationary pressure, these securities serve as a buffer, ensuring that the real value of your capital is preserved. Many investors overlook this aspect, focusing solely on nominal returns, but failing to account for inflation can erode wealth even when banks appear stable. Integrating TIPEs or similar inflation-protected instruments into your allocation demonstrates a proactive approach to wealth preservation. The global market offers additional options beyond domestic government securities. Sovereign bonds issued by stable economies around the world can diversify risk geographically, reducing exposure to country-specific crises. While foreign bonds introduce currency risk, political risk, and differing regulatory environments, they also offer opportunities to mitigate concentration risk in a single economy. By strategically allocating a portion of your portfolio to carefully selected international government bonds, you can protect against localized failures or economic downturns while maintaining the integrity of your overall investment strategy. Liquidity remains a critical consideration when investing in government-backed securities. Short-term instruments like T-bills or bonds with active secondary markets allow you to access funds relatively quickly if a sudden financial need arises. Unlike real estate or private equity, which can be difficult to liquidate under stress, government securities typically have transparent pricing and established markets, providing both security and flexibility. This combination of stability, predictability, and liquidity makes them a cornerstone for anyone seeking to safeguard wealth while maintaining the ability to respond to changing conditions. Risk management and psychological preparedness are integral to leveraging these instruments effectively. Many investors panic during financial crises, selling assets impulsively or reallocating funds to high-risk options in search of quick gains. By holding government-backed securities and bonds as a core component of your portfolio, you create a stabilizing anchor, a safe harbor that reduces the pressure to make hasty decisions. The strategic buffer allows you to navigate market turbulence with clarity, maintaining composure and making informed moves rather than reactive ones. Portfolio construction also benefits from blending government securities with other diversified holdings. While bonds provide safety and predictable returns, they are not immune to interest rate risk. When rates rise, bond prices fall. Combining them with insured cash accounts, short-term instruments, and diversified equities creates a multi-layered defense against various market scenarios. Each component plays a role: liquid accounts for emergencies, bonds for stability and income, and diversified assets for growth and opportunity. This holistic approach reflects the mindset of seasoned investors who anticipate systemic shocks and position their portfolios to absorb volatility rather than be devastated by it. Understanding the nuances of each security type, maturity, and yield structure is essential to maximizing effectiveness. Blindly investing in bonds without considering duration, credit quality, or inflation impact can leave your portfolio exposed in subtle ways. Strategic selection, informed by ongoing market analysis and risk assessment, ensures that your government-backed holdings serve their intended purpose, preserving wealth, providing predictable income, and acting as a shield against financial instability. This deliberate approach transforms government securities from simple investments into powerful instruments of financial resilience. Careful monitoring and periodic rebalancing enhance the effectiveness of this strategy. As interest rates, inflation expectations, and economic conditions evolve, the composition of your bond and government securities portfolio should be reviewed and adjusted. This ensures that your holdings remain aligned with your risk tolerance, liquidity needs, and long-term objectives. By actively managing these instruments rather than leaving them static, you maintain control over your exposure and reinforce the protective layer they provide, positioning yourself to weather both expected and unforeseen financial turbulence. Monitoring banking sector health and warning signs is an essential discipline for anyone serious about safeguarding their wealth in 2026. Even when your funds are diversified across insured accounts and government-backed securities, understanding the underlying health of the financial institutions that hold or manage your money can mean the difference between proactive action and reactive panic. Banks are complex entities with exposures that are not always visible to the everyday depositor. They rely on borrowing, lending, investment portfolios, and derivatives that can multiply risk in ways that are hard to detect without careful observation. Sudden instability in a major bank can cascade quickly, impacting other institutions and the broader economy, making vigilance a critical part of any financial strategy. Keeping an eye on early warning signs allows you to act decisively, moving or reallocating assets before a minor issue escalates into a crisis. One of the first indicators to track is the financial statements of the banks where you hold deposits or investments. Quarterly and annual reports provide into a bank's asset quality, loan exposure, and capital reserves. A rise in non-performing loans and high-risk lending can signal that the institution is stretching beyond safe limits. Similarly, the ratio of capital to assets, known as the capital adequacy ratio, indicates whether the bank has sufficient buffers to absorb potential losses. Banks with declining ratios may be at risk of insolvency if adverse events occur. By reviewing these indicators regularly, you gain a clearer picture of how secure your deposits and investments truly are, allowing you to anticipate problems rather than being blindsided by them. Liquidity indicators also offer critical insights. Banks need to maintain sufficient liquid assets to meet customer withdrawals and obligations. When a bank's liquidity ratios decline, it may indicate that the institution is struggling to balance its short-term obligations with longer-term investments or loans. News of tightening liquidity, increased reliance on central bank support, or difficulties in accessing interbank lending markets should be taken seriously. These early warning signs often precede more visible crises, and being alert allows you to take protective measures whether that involves redistributing deposits, securing alternative banking relationships, or adjusting your investment allocations. Regulatory reports and ratings are another crucial source of information. Agencies that oversee banking operations, such as the Federal Reserve or Office of the Comptroller of the Currency in the United States, issue regular assessments of banks' safety and soundness. In addition, independent rating agencies evaluate banks' creditworthiness and financial stability. Sudden downgrades or negative reports can signal underlying problems that are not yet widely reported in the media. Staying informed about these regulatory signals and professional assessments enables you to act with foresight. Shifting funds or diversifying your holdings before a crisis erupts, market signals often provide additional clues. For example, if a bank's stock price or bond yields deviate significantly from industry norms, it may indicate that investors are anticipating problems. Rising borrowing costs, falling stock valuations, or unusually high volatility in trading patterns are not merely numbers on a page. They reflect the collective judgment of market participants who often detect trouble before regulators or news outlets. Paying attention to these signals adds a real-time layer of monitoring that complements your review of official reports and statements, allowing you to gauge market sentiment and potential risk exposure. Customer behavior can also serve as a subtle yet revealing warning sign. Sudden increases in deposit withdrawals, shift to competitors, or news about account closures can reflect eroding confidence among clients who may sense issues before they are formally announced. While individual anecdotal reports should not be overinterpreted, patterns and trends across multiple sources often reveal cracks in trust that could precede liquidity or solvency problems. Monitoring online forums, news reports, and financial discussion platforms can provide early insights into such trends, giving you time to respond strategically rather than reactively. Stress testing is another tool worth understanding. Regulatory bodies and large BAM cells often conduct stress tests to simulate extreme economic conditions and measure how well the institution would withstand shocks. While these tests are not foolproof, reviewing results and understanding their implications provides a window into potential vulnerabilities. Banks that barely pass stress tests or show declining resilience over consecutive periods may require closer scrutiny and precautionary measures from depositors and investors alike. Transparency and governance issues also deserve attention. Banks with opaque structures, complex financial instruments, or aggressive risk-taking strategies are inherently more vulnerable. When leadership changes frequently or there is a history of regulatory fines, lawsuits, or accounting irregularities, these factors compound risk. Observing governance quality, management stability, and operational transparency allows you to gauge whether a bank is managed prudently or taking excessive risks that could threaten your assets. Technological and cybersecurity risk is increasingly relevant. In an era where digital banking dominates, institutions with weak cybersecurity measures, outdated infrastructure, or repeated system failures can face crises that impact both operations and confidence. A bank's ability to manage operational risks, respond to cyber threats, and maintain uninterrupted services is as important as its financial ratios. Because a technical collapse can panic even in fundamentally sound institutions. Regularly monitoring these diverse signals, financial statements, liquidity ratios, regulatory reports, market indicators, customer trends, stress tests, governance quality, and technological robustness creates a comprehensive picture of banking health. Staying vigilant allows you to anticipate problems, respond strategically, and protect your assets from unexpected shocks, turning insight into actionable defense in an increasingly volatile financial landscape. Exploring alternative financial institutions and fintech options has become a critical strategy for safeguarding wealth as traditional banks face increasing uncertainty. While diversification across conventional banks, insured accounts, and government-backed securities forms a strong foundation, relying solely on legacy finance institutions can leave you vulnerable to systemic risks and slow-moving crises. Fintech platforms, online banks, And non-traditional financial institutions provide opportunities to access innovative solutions, higher yields, and additional layers of protection that were once unavailable to individual investors. The financial landscape is evolving rapidly, and the most proactive investors understand that embracing alternatives can create flexibility, efficiency, and resilience in the face of uncertainty. Alternative banks, such as regional institutions, credit unions, and online-only banks, often operate under different risk profiles than large national banks. Regional banks typically have deeper local knowledge, more conservative lending practices, and lower to complex financial instruments that can destabilize major institutions. Credit unions, structured as member-owned cooperatives, prioritize stability and community-oriented practices, often providing insurance through national schemes like the NCUA. By shifting a portion of your funds to these alternatives, you reduce concentration risk and protect assets from the vulnerabilities of highly leveraged, globally interconnected banks. Moreover, these institutions frequently offer competitive interest rates, personalized services, and lower fees, making them both secure and efficient avenues for storing capital. Fintech platforms take this approach further by leveraging technology to provide innovative financial solutions that traditional banks may lack. Digital wallets, app-based savings and investment accounts, peer-to-peer lending platforms, and automated investment services allow investors to manage their assets with unprecedented convenience and control. Many of these platforms are insured or regulated, providing both security and liquidity while allowing access to higher-yielding products. The transparency of fintech dashboards, real-time monitoring, and automated alerts enhances your ability to react to market changes, track exposure, and optimize allocations. This immediacy of information transforms your financial strategy from passive management into active oversight, giving you an edge when volatility strikes. One significant advantage of fintech and alternative institutions is the ability to spread risk across multiple channels efficiently. Rather than having all funds tied to a single banking ecosystem, you can allocate cash to insured online accounts, invest in low-risk digital bonds, participate in peer-to-peer lending with secure platforms, or even explore cryptocurrency-based stable assets that offer diversification outside traditional banking. Each channel functions as an independent layer of protection, allowing you to maintain liquidity, generate returns, and mitigate exposure to bank-specific failures. This multi-channel approach mirrors the thinking of seasoned investors who anticipate systemic shocks and prioritize resilience alongside opportunity. Regulatory considerations are essential when exploring these alternatives. Not all fintech platforms operate at the same insurance or oversight as traditional banks, so understanding the protections in place is critical. Some platforms offer FD or equivalent insurance, while others rely on escrow arrangements or private insurance schemes. Carefully reviewing terms of service, security protocols, and insurance coverage ensures that your funds are not just theoretically protected, but practically secure. Failure to verify regulatory compliance can expose you to operational or counterparty risks that offset the benefits of alternative options. Technological literacy is also key. While fintech provides convenience and innovation, it requires active management, cybersecurity awareness, and a willingness to adapt to evolving platforms. Ensuring strong passwords, two-factor authentication, and secure devices is essential, as cyber threats can disrupt access to accounts or compromise assets. A disciplined approach to digital security mirrors the careful planning applied to traditional diversification strategies, creating a comprehensive shield against both financial and operational risks. The flexibility offered by alternative institutions also supports strategic asset allocation. High-yield digital accounts, fractional investment platforms, and automated portfolio managers allow you to move funds rapidly between instruments, respond to market changes, and optimize returns without being constrained by rigid banking structures. For example, if a traditional bank shows signs of instability, you can quickly shift funds into a secure account or government-backed instrument, maintaining both safety and liquidity. This adaptability is a powerful tool in an unpredictable environment, enabling you to act preemptively rather than reactively when warning signs emerge. Psychologically, incorporating alternative institutions can reduce anxiety during crises. Knowing that part of your wealth is distributed across secure, non-traditional channels creates confidence and a sense of control, allowing you to make rational decisions even as market headlines induce panic elsewhere. The empowerment that comes from real-time access, transparency, and diversified options reinforces a proactive mindset, which is critical for long-term financial stability. By blending conventional banking, government securities, and alternative platforms, you construct a multi-layered defense that is responsive, resilient, and forward-looking. Global considerations further enhance the benefits of alternative institutions. Some fintech platforms allow access to international accounts, multi-currency holdings, and cross-border investment opportunities, providing geographic diversification alongside institutional diversification. By spreading assets across borders and systems, you reduce exposure to localized economic shocks or regulatory changes while gaining access to global opportunities. This global perspective aligns with the strategy of experienced investors who view financial security not as static but as a dynamic system capable of adapting to volatility. Finally, integrating alternative financial institutions into your wealth protection strategy encourages continual monitoring and learning. The landscape evolves quickly, with new platforms, regulations, and technological solutions emerging regularly. By actively engaging with these options, you stay informed, adaptable, and prepared, ensuring that your portfolio remains secure, liquid, and optimized for both current and future challenges. This proactive, multi-dimensional approach turns alternative financial institutions and fintech options from experimental tools into essential instruments for navigating uncertainty and preserving wealth. Maintaining liquidity for emergencies and unexpected withdrawals is the final, critical layer of financial defense in a world where banking stability can shift overnight. No matter how diversified your portfolio is across traditional banks, government-backed securities, or alternative fintech platforms, the ability to access cash quickly during a crisis is what separates preparedness from vulnerability. Financial shocks can come in many forms: bank insolvencies, rapid interest rate changes, regulatory interventions, or even geopolitical events that disrupt market operations. Having liquid assets ensures that you can respond decisively, cover essential expenses, and seize opportunities that arise while others scramble or remain frozen by uncertainty. Liquidity is not merely a convenience, it is a lifeline, a buffer that allows strategic action rather than reactive panic. The first step in maintaining liquidity is identifying the portion of your portfolio that must remain readily accessible. While long-term investments in higher-yield instruments serve important roles in wealth preservation and growth, they often require time to convert to cash without penalties or losses. By clearly separating short-term liquid assets from longer-term holdings, you create a structure where immediate needs can be met without disrupting strategic investments. This involves holding funds in highly liquid accounts, such as checking and savings accounts with government insurance, money market accounts, or short-term treasury instruments that can be sold quickly without significant loss of value. Determining the right balance between liquidity and return requires careful planning, factoring in monthly expenses, emergency reserves, and anticipated market volatility. Stress testing your liquidity needs is another vital step. Consider scenarios such as a bank freeze, sudden regulatory changes, or a market downturn that limits access to funds. Calculate the amount of cash you would need to cover essential living costs, debt obligations, and emergency expenditures for a realistic period, typically 3 to 12 months, depending on your personal circumstances. This reserve acts as a financial firewall, allowing you to withstand temporary disruptions without being forced to sell long-term investments at a loss. The psychological benefit of knowing that liquidity is in place cannot be overstated. It reduces fear-driven decisions and provides a sense of control in uncertain times. Diversification of liquid assets also strengthens resilience. Rather than keeping all emergency funds in a single account or institution, spreading cash across multiple banks, credit unions, and digital platforms ensures access even if one institution encounters difficulties. Different account types and structures, such as joint accounts, trust accounts, or insured digital wallets, can also maximize coverage limits under government protection. This approach mirrors the layered strategy used for broader portfolio diversification, applying the same principles of risk mitigation and proactive management to your most immediate financial needs. The strategic use of short-term instruments further enhances liquidity. Treasury bills, short-duration bonds, and money market funds can provide slightly higher returns than cash in a checking account, while maintaining the ability to convert quickly. Many of these instruments offer competitive interest with minimal risk, acting as an intermediary between pure cash and longer-term investments. By incorporating these tools into your liquidity plan, you maintain flexibility and growth potential without compromising accessibility. Laddering short-term maturities ensures a continuous flow of funds becoming available, smoothing the process of meeting cash needs while optimizing yield. Technology plays an increasingly important role in liquidity management. Mobile banking, online transfer platforms, and real-time monitoring allow instant access to funds, rapid reallocation between accounts, and alerts for unusual activity. Digital tools also help track balances, monitor withdrawal limits, and identify optimal timing for moving between liquid and longer-term assets. However, technology introduces operational risk, so it is essential to maintain multiple access points, secure devices, and strong authentication protocols. Combining technological convenience with redundancy ensures that you are never locked out of your funds when timing and speed are critical. Liquidity planning must also take into account tax considerations and penalties associated with withdrawing from certain accounts. Retirement accounts, certificates of deposit, or investment funds may impose penalties or tax consequences if accessed prematurely. Understanding these restrictions allows you to structure your liquid reserves so that they remain fully accessible without triggering unnecessary costs. By anticipating potential scenarios, you can position assets in a way that preserves both access and value, maintaining a ready pool of funds for emergencies or unexpected opportunities. Behavioral discipline is just as important as the structural elements of liquidity. The mere existence of liquid assets does not protect you if you fail to use them wisely or succumb to panic. Establishing rules for accessing emergency funds, such as only using them for genuine crises or time-sensitive opportunities, reinforces financial discipline and ensures that liquidity serves its intended purpose. Regularly reviewing and adjusting liquidity reserves in response to changes in income, expenses, or risk exposure further strengthens preparedness. Proactive monitoring prevents erosion of your financial firewall over time and ensures that reserves remain sufficient and functional. Global diversification of liquid assets adds another protective layer. Holding funds in institutions or accounts across multiple jurisdictions can safeguard against regional banking disruptions, currency fluctuations, or local regulatory interventions. International accounts, foreign-denominated instruments, and multi-currency digital wallets offer access to additional financial ecosystems, enhancing both security and flexibility. While these options require attention to legal, tax, and regulatory details, they provide a strategic advantage when domestic systems experience stress, giving you alternative avenues for maintaining immediate access to funds. Psychologically, the security provided by liquidity cannot be overstated. Knowing that cash is available to cover unexpected expenses, respond to market dislocations, or take advantage of opportunities instills confidence, reduces stress, and promotes rational decision-making during times of uncertainty. It transforms a reactive mindset into a proactive strategy, where actions are driven by planning rather than fear. Liquidity, therefore, is not merely a technical or operational consideration. It is a cornerstone of financial resilience, enabling both survival and strategic maneuvering in volatile environments. By maintaining liquidity for emergencies and unexpected withdrawals, you ensure that your wealth is not only protected but also agile. Liquid reserves serve as a buffer, a stabilizing force, and a tool for opportunistic action, complementing the layers of protection provided by diversified accounts, government-backed securities, and alternative financial institutions. This combination of accessibility, security, and flexibility transforms financial preparedness from theory into practical, actionable strength, empowering you to navigate uncertainty with confidence, foresight, and control.